Hello guys, this is Veeru Skill Development Center. Here we have a second class, and as earlier discussed, and we have aggregated the topic as nature of transaction. Over the centuries, an accounting has remained confined to the financial record keeping functions of the accountant. The economic events are identified, measured, and recorded in order that the pertinent information is generated and communicated in a certain form to the management and other internal and external users. Basic terms of accounting. For example, first one is entity, transaction, assets, liabilities, capital, sales, revenues, expenses, expenditure, profit, gain, loss, discount, goods, voucher, drawings, purchases, stock, debtor, creditor. And these are the basic terms conditions, and I will explain one by one. For example, entity means a really that has a definite individual existence. Business entity means a special identifiable business enterprises like a super bazaar, hire jewelers, ITC limited. An accounting system is always devised for a specific business entity is called as accounting entity. And the second one is transactions. A event involving some value between two or more entities. It can be a purchase of goods, receipt of money, payment to a creditor, incurring expenses, etc. Can be a cash transaction or a credit transaction. And the third one is assets. Assets are economic resources of an enterprise that can be usefully expressed in a monetary terms. Assets are items of value used by the business in the operations. And the fourth one is liabilities. Liabilities are obligations or a debt that an enterprise has to pay to someone in the future. And the capital. Capital means an amount invested by the owner in the firm is known as capital. Sales. Sales are total revenues from goods or services sold or provided to the customers. Either it may be cash sales or credit sales. Then go for revenue. And these are the amounts of business earned by selling its products or providing services to the customers called sales revenue. And next one is expenses. Cost incurred by a business in the process of earning revenue are known as expenses. And then expenditure. The spending amount or incurring liability for some benefit, service, or property received is called as expenditure. For example, payment of rent, salary, purchase of goods, purchase of machinery, purchase of furniture, and these are the profit. The excess of revenue of a period over its related expenses during an accounting year is profit. Gain. A profit that arises from events or transaction which are incidental to a business, such as sale of fixed assets, winning a court case, appreciation in the value of an asset, and then go for loss. The excess of expenses of a period over its related revenues it's termed as loss. It decreases the owner's equity. It also refers to a money or money's worth lost without receiving any benefit in return. And discount. Discount is a deduction in the price of goods sold. It is offered in two ways. Offering reductions of agreed percentage of list price at the time of selling goods is one way of giving discount. Such discount is called as trade discount. Then goods. It refers to the products in which the business unit is dealing in terms of it is buying and selling or producing and selling. And voucher. The documentary evidence in support of a transaction is known as voucher. And then go for drawings. Withdrawal of money and goods by the owner from the business for personal use is known as drawings. And purchases. Purchases are total amount of goods procured by business on a credit or on a cash for use or sale. And then go for stock. Stock is a measure of something on hand goods, spares and other items in a business. It is called as stock in hand. And then go for debtors. Debtors are the persons or other entities who owe to an enterprise an amount for buying goods and services on a credit. The total amount of standing against such persons or entities on the closing date it is shown in the balance sheet as sundry debtors on the asset side. And the last one is creditors. Creditors are persons or other entities who have to pay by an enterprises an amount for providing the enterprises goods and services on a credit. That is called as creditor. Accounting system. Here we have a major difference of single entry system and double entry system. For example, in a single entry system, bookkeeping only one effects of transaction is recorded which is related to our business. And if for example in double entry system, the bookkeeping only both or all effects of transaction is recorded in the books of account. In single entry, it is not accepted by the income tax department and double entry system will accept it. And the next class will be taken on the following descriptions. Go through it and ready for that. Thank you.